In 2007, while the entire financial system believed the good times would never end, one man saw what almost no one else could see. He placed a bet so audacious, so contrarian, that Wall Street called him reckless. Then the collapse came. And that same man walked away with one of the greatest fortunes in financial history. Now, nearly 2 decades later, he is speaking again. Not about mortgages this time, not about banks, but about something far more fundamental, something that touches every single person watching this right now. He says a new storm is building, quietly, beneath the surface of the global economy. And he says gold is only at the beginning of its story. What does he see that the rest of the world still refuses to accept? Stay with us, because by the end of this video, you will understand exactly why. Welcome back to Precious Metals Intelligence, the channel dedicated to decoding the strategic economic forces shaping wealth, currency, and power in the modern world. Whether you are a long-time investor, a business professional, or simply someone determined to understand what is really happening behind the headlines, you are in exactly the right place. Today's story is one of the most important we've covered this year. So settle in and let's begin. In the years before 2008, the American housing market looked unstoppable. Home prices kept climbing, banks kept lending. Millions of people believed that real estate could never fail. Wall Street was confident, regulators were calm. Almost everyone believed the good times would continue forever. But one investor did not believe it. He looked at the numbers behind the housing boom, and what he saw troubled him deeply. Millions of home loans were being given to people who could not really afford them. These loans were then packaged together and sold to investors around the world as if they were safe. He studied the system carefully, and he came to a conclusion that almost no one else on Wall Street was willing to accept. This entire system was built on a dangerous illusion. He believed the housing market was heading toward collapse, and he decided to act on that belief. At the time, this was not a popular position. Betting against the housing market meant betting against banks, against government policy, and against the confidence of nearly every major financial institution in the country. Many people thought his view was extreme. Some thought it was simply wrong. Bankers dismissed his warnings. Analysts questioned his judgment. Even close colleagues doubted whether his strategy made any sense at all. He did not change his mind. Instead, he built a position that would grow enormously in value if the housing market fell apart. This was a risky and unusual move. It required him to go against the entire financial establishment. It required patience, discipline, and a willingness to be wrong in the eyes of the world for a long period of time. For months, nothing happened. The housing market kept rising. His critics felt validated. Pressure was building on him to give up his position and admit defeat. But he held firm. Then, slowly at first, cracks began to appear. Homeowners began falling behind on their payments. Mortgage companies began reporting losses. The confidence that had defined the housing market for years began to weaken. What started as a small warning sign soon turned into a much larger problem. By 2007 and into 2008, the cracks became a full collapse. Major financial institutions that had seemed unshakable were suddenly in serious trouble. Some collapsed completely. Others needed emergency support just to survive. The financial system that so many people had trusted was now shaking at its core. While most of the world was losing money, panicking, or simply trying to survive the chaos, this investor's earlier bet was paying off in a historic way. His decision to go against the crowd, made years earlier when almost no one agreed with him, turned into one of the most successful trades in modern financial history. He did not just survive the crisis. He became one of the very few people who profited enormously from it. Overnight, his name became known far beyond financial circles. He was seen as someone who had understood something that governments, banks, and top economists had missed. He had studied the system closely, trusted his own analysis, and stood by it even when everyone around him disagreed. This story made him famous, but it also gave him something more valuable than fame. It gave him deep insight into how financial systems can quietly build up hidden risks, long before the public notices anything is wrong. He learned that confidence and stability can look very convincing right up until the moment they fail. He learned that the biggest dangers are often the ones that most people refuse to see, simply because everyone around them is choosing not to look. That lesson would shape the next chapter of his career. In the years that followed 2008, as governments and central banks responded to the crisis with massive financial intervention, he did not simply walk away and enjoy his success. He kept watching, he kept studying. And slowly, he began to notice a new pattern forming, one that reminded him of the warning signs he had seen before. This time, the story was not about housing. It was about something much bigger, something connected to money itself and how much trust people should really place in it, and that is where his attention would soon turn. Fame did not slow him down. If anything, it pushed him to look even harder at the world around him. After 2008, most people wanted the crisis to simply end. Governments wanted stability. Banks wanted trust to return. The public wanted to move on and forget what had just happened. But this investor was not interested in moving on. He wanted to understand what had really caused the damage, and more importantly, what the response to that damage might cause next. What he saw troubled him again. To stop the financial system from collapsing completely, governments and central banks took extraordinary action. Huge amounts of money were created almost overnight. Interest rates were pushed down to levels rarely seen before. Banks were rescued with emergency support. On the surface, this seemed to work. Markets calmed down. Confidence slowly returned. But underneath that calm surface, something important was changing, and very few people were paying attention to it. He began to ask a different question. Not how do we fix this crisis, but what happens to money itself when a crisis is fixed this way? The answer, in his view, was troubling. When huge amounts of new currency are created to solve a problem, that currency does not simply disappear once the problem is solved. It stays in the system. Over time, it can quietly reduce the real value of the money that everyday people hold, save, and work for. This process is slow. It is not always obvious. But it is powerful, and it does not stop just because the news cycle moves on. This idea led him towards something very different from his housing trade. He began looking seriously at gold. Gold is different from currency created by governments. It cannot be printed. It cannot be expanded at will to solve a short-term problem. For thousands of years, long before modern banking existed, people have turned to gold as a way to protect wealth when trust in money itself becomes uncertain. He understood this history well, and he began to see modern parallels forming in real time. So, in the aftermath of the crisis that made him famous, he made another decision that surprised many people. He started building a position in gold. It is worth noting that he was not the very first person to see this opportunity. Some investors had already recognized gold's potential earlier when prices were still low and had been rewarded handsomely for their early conviction. By the time he entered, gold had already climbed significantly from where it once stood. Still, he believed the bigger story was far from finished. He was not looking for a quick profit. He was positioning for what he believed would be a long and slow transformation in how the world viewed money itself. This was not a simple, straight path. Gold does not move in one direction forever. In the years that followed, there were periods where gold prices fell. There were long stretches where interest in gold faded, and other investments captured public attention instead. During these quieter years, many casual investors lost patience and moved on to other opportunities. But he did not treat gold as a short-term trade. He treated it as a long-term response to a long-term problem, one rooted in how modern currencies are managed. Over time, the pattern he had identified years earlier began to repeat itself in new forms. Government spending continued to grow. Debt levels around the world continued to rise. Central banks continued to rely on the same basic tools they had used during the original crisis, expanding money supply whenever new economic pressure appeared. Each time this happened, it reinforced the same lesson he had learned back in 2008. Confidence in a financial system can look strong right up until it is tested, and the tools used to protect that system often come with hidden long-term costs. This is the deeper reason his recent comments have carried so much weight. He is not simply reacting to short-term market movements. He is speaking from a position built on nearly 2 decades of watching the same pattern unfold again and again, just in different forms and different disguises. And now, according to him, the pattern is entering a new and more serious stage. One that involves not just individual investors, but entire governments, quietly changing how they think about money, reserves, and long-term financial security. When this investor appeared on CNBC recently, he was not offering a passing comment. He was describing a shift that he believes is already well underway, one that most everyday investors have not yet noticed. His message was direct. He explained that trust in paper currencies continues to weaken, and that this trend is not slowing down. Central banks, he said, are responding to this reality in a very practical way. They are buying gold, and they are buying it in large amounts. This is not simply his personal opinion. It is backed by what has actually been happening around the world in recent years. Since 2022, a major turning point occurred that changed how many nations think about financial security. When certain countries had their currency reserves frozen as a form of economic pressure, it sent a clear signal to governments everywhere. Holding wealth in another nation's currency, no matter how powerful that nation may be, comes with risk. That wealth can be restricted. It can be limited. In some cases, it can be effectively taken out of reach. Nations that witnessed this took notice. Some began shifting their strategy in a very deliberate way, moving away from heavy reliance on foreign currency reserves and moving instead towards something that cannot be frozen, restricted, or controlled by another government, physical gold. Russia has increased its gold holdings substantially in the years following that event. China has done the same, and by most official reports, its gold buying has been extensive. However, this investor and others who study the gold market closely believe the real total may be even higher than what is publicly reported. Poland has also emerged as a major buyer. Several other nations have quietly followed the same pattern, expanding their gold reserves step by step, year after year. This is an important detail. These are not short-term traders looking for a quick gain. These are national governments making long-term decisions about how to protect their wealth for decades to come. When a government moves in this direction, it usually does not move back quickly. This kind of shift tends to build slowly and steadily over time. According to this investor, this same thinking has now spread beyond central banks. He has pointed out that very wealthy individuals and private family offices, the kind of investors who manage enormous amounts of money quietly and without public attention, are also increasing their exposure to gold. This is happening largely outside of public view, through private channels rather than public markets. This detail matters a great deal. Family offices and major private investors are generally known for careful, long-term thinking. They typically do not chase short-term trends. When capital of this kind moves into an asset gradually and consistently, it is usually a sign of a deeper, more strategic decision rather than a passing reaction to daily headlines. He believes that everyday individual investors are, generally speaking, still behind this shift. Many have not yet fully recognized what is happening at the government and institutional level. In his view, based on historical patterns, the broader public often becomes seriously interested in an asset like gold only in the later stages of a long upward trend, often at a point where much of the larger, easier gains have already occurred. This is precisely why he considers this current moment to be so significant. It is not simply a story about the daily price of gold moving up or down. It is a story about a structural change taking place in how the world thinks about money, safety, and long-term financial protection. For decades, one major currency served as the dominant foundation of global finance, trusted by nearly every nation as the safest place to hold reserves. That level of trust, once viewed as almost unquestionable, is now being reconsidered by governments around the world. And when trust in a monetary system begins to shift at this scale, the effects rarely stay confined to central banks alone. They tend to eventually reach the ground level, and that includes the businesses and individuals still relying on outdated assumptions about how safe traditional currencies really are. This growing gap between what governments and major institutions are quietly doing and what the general public still believes brings the story to its next crucial layer. Because if the biggest and most sophisticated financial players are already repositioning, the next question becomes obvious. Where exactly are they placing that capital within the gold market itself? And what does that reveal for those willing to look closely enough? If gold itself represents the foundation of this shift, the mining sector represents something else entirely, an opportunity that, according to this investor, has been largely overlooked. He has pointed to a detail that many casual observers miss. Mining companies that produce gold are currently generating some of the strongest free cash flow of any sector in the entire stock market. This means these companies are bringing in significant profit relative to their size and operations. Yet, despite this strong financial performance, the value placed on many of these companies by the broader market remains low. In simple terms, these businesses are making solid money, but their stock prices have not caught up to reflect that success. This gap between strong performance and weak market value is exactly the kind of situation long-term investors look for. It suggests that the mining sector may still be in an early stage of recognition, even while the price of gold itself has already climbed significantly. According to this investor, there are different ways to gain exposure to this sector, and each comes with its own level of risk. The first category includes early-stage mining companies. These are businesses that have identified gold deposits but have not yet begun full production. This type of investment carries real appeal because of its potential for large returns if a project succeeds. However, it also carries real danger. Many early-stage mining projects never make it to full production. Some face funding problems, others face technical or regulatory setbacks. A significant number of these companies ultimately fail to deliver on their original promise. The second category includes companies that are closer to production, meaning they have already done much of the difficult early work and are approaching the point where they will begin generating real revenue from their gold reserves. This stage generally carries less uncertainty than early exploration, though it is still not without risk. The third category involves what are sometimes called restart companies. These are mining operations that were once active and successful, but were forced to shut down during a prolonged period when gold prices were low and mining was not profitable. Many of these operations closed between the early 2010s and the years leading up to 2022, a stretch during which gold struggled to maintain strong momentum. Now, with gold prices rising again, some of these previously closed operations are being reconsidered. They already have a track record. They already have infrastructure and experience behind them. This can make them an interesting middle ground between the higher risk of early-stage exploration and the higher cost of investing in companies that are already fully established. This investor has specifically referenced one such company involved in early to mid-stage development, citing its large resource base as an example of the kind of leveraged exposure to gold prices that some investors are seeking. He explained that when a company holds a substantial amount of gold still in the ground, and that gold is priced by the market at only a small fraction of gold's actual current value, It can offer investors a way to gain amplified exposure to future gold price increases. However, he was also careful to note an important distinction that is easy to overlook. Not all resources in the ground carry the same level of certainty. Some amounts are considered highly confirmed, based on extensive studies and data. Other amounts are considered probable, based on geological patterns, rather than complete confirmation. Investors who fail to understand this difference may end up with an overly optimistic view of a company's true value. This is a critical reminder woven throughout his broader message. Opportunity and risk exist side by side in this sector. The potential rewards can be significant, but so can the potential for disappointment, particularly for those who invest without fully understanding what they are buying. And this reminder leads directly into the final and most urgent part of the story, the one that ties together everything examined so far, and asks what it all means for those watching closely enough to act before the wider public catches on.